Invest in AI and avoid the bubble. Ciao guys, welcome back to lorenzo2cents.com, and today I'm going to tell you what is my strategy to invest in AI and avoid the bubble. Because of course, investing in AI isn't optional if you want to have superior returns, right, over the next years. So you cannot just say I'm going to invest, in oil and gas. Yeah, right. I will have a dividend. If you are happy with 5-10% per year, then it's good. But if you want to overperform the market, then you need somehow to play the AI story here, right? But at the same time, we all know that eventually all these super cycle capital expenditure will cool down, right? Or will end, and this will happen suddenly, and nobody knows if it is in 1 month, 1 year, or 10 years. So we just need to play it smartly, and I'm going to tell you how I'm playing it, right? So let me just remind you that this is not financial advice, so conduct your own research. This is just for informational purpose. So let's go through it. What I did, I tried to divide the potential investments in various categories, and this is it. What I'm showing here is a table I came out that summarizes everything. So basically, for each category, I have identified if there is a potential, it's ongoing, or a potential bottleneck, so supply-demand imbalance, that so is a short-term tailwind. And just let me say that when I say short-term, I say short-term compared to the entire super cycle of AI capital expenditure. But of course, if the super cycle lasts like 10 years, then the short term is maybe 5 years, right? So it's short term is not really short term. It depends. It could be 1 week or it could be 10 years. Okay. Then second, I wondered, do these category of investments directly and proportionately benefit from AI capital expenditure? Yes or no? Because of course, again, this is a tailwind as long as the demand doesn't cool down. Then it gets like you will get hammered, right? If there is a correlation that is very high here. Third and last, does this category have potential durable and defendable edge? So let's go through each one of these categories. So first, AI-powered product and services. Think about Lemonade, right? They provide insurance services here. So is there a bottleneck? No, there are hundreds of companies providing insurance services, and there will always be. So no bottleneck here, no imbalance between supply and demand. So no tailwinds. Do they directly and proportionately benefit from AI capital expenditure? No, or at least the correlation is low. Why? Because yes, you get indirect gains, like the LLMs get better, then you improve your operation, but your revenues are not correlated to this, right? Because your revenues come from your customers that are end users. And then, do they have potential durable and defendable edge? Yes. If, for example, they have a proprietary data moat data set they can use, right? Or if they have a strong distribution edge. Second category, AI powered application. Any bottleneck here? No, same as the first category. Do they directly and proportionately benefit from AI CAPEX? Same as the first category. No, correlation is low. Indirectly, yes, but correlation is low. Their revenue don't come from the hardware capital expenditure. The revenue comes from, think about here, just to make an example, think about Palantir, right? They provide an app or a software that is a tool to leverage, take advantage of AI. So the revenue comes from the customer. So yes, for sure, if there is a cool down of the AI hype, then they could somehow get punished for that, but they for sure don't benefit directly from the revenue spent in the chips and hardware. Even though I took Palantir, probably it's more, rather than a low correlation, it's a medium, but you get the point. I mean, probably I picked the wrong example, but in general, AI-powered applications don't have a high correlation on this. Then third, potential durable and defendable edge. Yes, same as the first category. Proprietary data, moat, or strong distribution edges. Third, product, AI models, and I'm coming from the top to the bottom, right, of the AI stack. So AI models, LLMs. Think about Google with Gemini, think about OpenAI with GPT, and so on. So bottleneck, no. There is plenty of supply, and this is being an immaterial product. I mean, you can have as much as you want. There is no supply-demand bottleneck here. I mean, unless it is correlated to potentially there could be, because it is correlated with AI chips and compute. So if you don't have compute, you cannot deliver service. But I mean, I think it's unlikely, or at least now it's not there. But yeah, maybe it's not a net no here. It could be, but likely no. Then, do they directly and proportionately benefit from AI capital expenditure? Medium correlation, because they benefit from compute investment, like more compute they get better because they can train again and again and so on. Then potential durable, do they have or can have a potential durable and defendable edge? Partial. So yes, if you are in a niche, in a vertical, think about coding, Anthropic with code for coding. For sure you have an edge, you have the best model, you have some kind of edge. But I believe that for 90% of the basic enterprises workflow, probably open source will cover it, right? Because you don't need the best of the best. Probably with the level you are now with open source, it's already fine. For if you need to, I don't know, write an email or summarize, it's fine even with Llama or with open source model, DeepSeek, whatever it is. So here it is partial. You need to be in a niche and be specialized on something, or you need to have your own app. Think about Google and so on. Next, AI silicon, so chips. Bottleneck, yes, of course, damn yes. It is ongoing and probably will last for long. So it's a tailwind, yes, because you have more demand than supply and you can take advantage of it. Do they directly and proportionately benefit from AI capital expenditure? Yes, here correlation is high. Probably it's 100% or almost there, meaning that when demand for new infrastructure, new compute will slow down, they will get hammered. Think about Nvidia and AMD. Probably the stock will drop 50%, 60%, 70%. It's perfectly possible here. It depends how much severe is this cool down, right? So when the music stops, they will stop dancing here. And do they have a potential durable and defendable edge? Yes. I think this is mostly via sticky software. So think about CUDA for NVIDIA. AMD is catching up. Yes, it's true. Even hardware could have or will have similar performance, but still you have most of the developers that are used to code and build on CUDA. So still probably NVIDIA will maintain an edge for long here. And even about this, think about they recently launched at the CES open source models, right? So these again are open source, so we'll have a bigger, strong adoption and are built on NVIDIA infrastructure. Or second possibility, or at least another possibility, is that if you have a strong integration between an LLM and the silicon, think about Google with the TPU, right? Next, AI infrastructure. Think about Nebius, think about Iron, think about core wave, and of course all the hyperscaler there. Bottleneck, yes. You have a bottlenecks, you need to move atoms, it takes time to build data centers. Absolutely, yes, and you are seeing it clearly in the revenue growth projection that all these I've just mentioned have. They expect to do like 5x, 10x for the revenue over the next 12 months. It's insane, right? So probably, I believe this is actually the biggest bottleneck among all, even bigger at this point than the silicon. Do they directly and proportionately benefit from AI capital expenditure? I think yes, at least initially when you have model training that eats most of the budget, then you have a shift to inference, meaning that even when capital expenditure will cool down, still enterprises, your end customers will keep using their model or workflows they have built on, right? All the use cases. So you still do inferences, and at that point inference probably will be most of the workload. So I would say it depends when the music stops. If it is stopped tomorrow, then yes, they will get hammered. If it stops in 5 years or 10 years, probably no, or at least their correlation will be quite low to medium probably. Then, do they have a potential durable and defendable edge? Yes. I think here again it's about software and services. Think about Nebius. They are building on top of their infrastructure a proprietary software layer, and even what they recently launched called the token factory, right? So they are trying to get developers building on their infrastructure. So this is what I think can differentiate the players in this category one from the other. And then last one, it's AI power. So bottleneck, yes, I think, most of what we have heard, we are hearing the last couple of months is that AI power supply is actually now the bottleneck, even more than the silicon, right? Because you have the chips, but you don't know how to feed them. So strong tailwind here in the short term. Do they directly and proportionately benefit from the high capital expenditure? Yes. I think here, again, the correlation is 100%, because when think about, I don't know if this is a real case or not, but think about an hypothesis. There is a company that is building some kind of equipment in the power supply stack, transformer, whatever it is, batteries or gas turbines, just for the data centers. So say 90% of their customers are hyperscalers and whoever, neo clouds and so on. When the capital expenditures will cool down, their revenue may go to zero. Yeah, even zero, right? For a quarter, because they don't have any recurrent revenue. They are just selling metal and equipment. And if their customers are not building new infrastructure, they are not getting any orders. So moat, any potential durable edge moat, no, this is a poor commodity unless very, very specific cases. So I think I can already spoiler here. I'm telling you, I don't want to be in the last line. I never want to be in the AI power play, because it's really, really dangerous. Yeah, if you are very speculative, a very quick action, but it's not my style, yeah, you can get in and make even a lot of money. But I don't want to be there. I'm investing for the long term, and this is not the play that makes me make money. So another spoiler. The first line, AI-powered product and services, is the one I like most, because you don't get the short-term tailwind. It's true, but if you find the right companies, and I think there are very few of them, a bunch of them that I have identified. Maybe I don't have identified all of them, but I think most of them, and I'm invested in. Then if you are in these companies, then you can get business that are compounding for decades here, because you can find really at this point in 2026 winners take all companies, right? So that is the most interesting for me, and I can start sharing that this is my portfolio that is allocated mostly to this category, more than 60%. Then some is allocated on the space sector. AI infrastructure is 12%, and then I have one play that you can bet which one it is, that is on Latin America economy. So go check my article on lorenzo2cents.com. You will find the direct link in the comments, and if you are a premium member, you can even see all the specific allocation and company within each of this category. What comes next? So this is a series, as I said. It's a new format I'm trying. So next episode will be published in about 1 week. It will be about specifically the AI-powered product and services. So I will be digging into this category, and I will let you know, I will tell you what are the companies I'm invested in this category, and why for each company, and what I do expect from them. Good. Stay tuned, guys, and see you soon. Ciao.